We said that macroeconomics was created for two main reasons. The first reason is to measure the entire economy. The second reason is to fix the economy whenever there is a problem. So now we want to look at the first reason for creating macroeconomics, which is to measure the entire economy. And the best way we can measure the entire economy is by measuring the gross domestic product of the country. So this time around, we'll be looking at the measurements of national income. How do we measure national income? National income is the money value of goods and services produced in a country over a given period of usually 1 year. So three methods can be used to measure the value of goods and services produced in a country over a given period of 1 year. Method 1 is called the expenditure method. Method 2 is known as the output method. And method 3 is the income method. So in this video, we'll be looking at a detailed explanation on the expenditure method. The expenditure method is mostly used in examinations in measuring national income because of its clarity and simplicity. So with the expenditure method, we start by looking at the formulas I have. Because this method involves measuring the expenditures carried on by all the economic agents in the economy within a given period of 1 year. And for the economic agents we have in a country, we have consumers, we have investors, that is the firms, we have the government, then we have the rest of the world, which is made up of exports and imports. So beginning first with looking at the total domestic expenditure at market prices, it is given by the formula consumption expenditure plus investment plus government expenditure. So for consumption, this is the expenditure made by consumers. For investment, it is all expenses made by firms, expenses on investment. Then G stands for government expenditure. All expenditures made by the government within a given period of 1 year. So if we move on to calculate the total final expenditure at market prices, we take consumption plus investment plus government expenditure plus the value of exports. Now for gross domestic product at market prices, it is consumption plus investment plus government expenditure plus export minus import. I want you to understand that export minus import is also called net export, because sometimes they will give you a question in the examination and they will not give you the value of export separate and the value of import separate. They will put it as net export. So once you see net export, it is export minus import. Now for the next, we have the gross domestic product at factor cost. For gross domestic product at factor cost, what we have is consumption plus investment plus government expenditure plus export minus import minus taxes plus subsidies. So if you look at it very well, you realize that we left market prices and we are now on factor cost. So moving from market prices to factor cost, what we take into consideration is the value of taxes and the value of subsidies. So you discover that we are subtracting taxes and adding subsidies. This is very simple and clear. The reason why we subtract taxes is because taxes increase the value of goods and services in the market, while subsidies reduce the value of goods and services in the market. So if we want to get the exact value of the goods and services, we need to subtract taxes so that we can get the exact value, and then we add subsidies in order to get the exact value of the goods and services. So the reason why we are subtracting taxes is because taxes instead increase the value of the good. So to get the real value, we have to reduce the taxes. Now, we move to gross national product. Gross national product. So gross national product is consumption plus investment plus government expenditure plus export minus import minus taxes plus subsidies plus net property income from abroad. That is NPIA. Remember, this net property income from abroad is simply calculated by taking property income from abroad minus property income paid abroad. Then we get the net property income from abroad. So you discover that when we move from domestic to national, from gross domestic product to gross national product, what has added here is what we call the net property income from abroad, remittances. Now the next thing is gross national product at market prices. If you are asked to calculate gross national product at market prices, take note, what you will be using is consumption plus investment plus government expenditure plus export minus import, which is gross domestic product at market prices. Then you add the value of net property income from abroad. So the difference is simply on the fact that on gross national product at factor cost, we take gross domestic product at factor cost and add the value of net property income from abroad. But when it is gross national product at market prices, we take gross domestic product at market prices and add the value of net property income from abroad. Now lastly, national income is calculated by getting the gross national product at factor cost minus the value of depreciation or capital consumption. Now let me show you the secret using this method. The secret, maybe they forgot to tell you, or maybe the person did not also understand that you needed to know this secret. So secrets in expenditure method. One of the first secrets is getting the value of investment expenditure. The value of investment expenditure, it must be net investment. So to get the value, what we do is this investment always has two it has two things that you must attach to it, and these two properties are always given in your data. So it involves gross domestic fixed capital formation plus physical increase in stocks and work in progress. The physical increase and work in progress is the same as changes in stocks. So in your data, they will either give you